This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup, the week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome to the Deep Dive, the show where we take, just a mountain of information and really try to distill it down to the essential nuggets you need to know. We're here to give you that shortcut, right? To being truly well-informed, but, without all the information overload. Today, we're doing something a little different. It's actually really exciting, especially for you, if you're navigating the real estate world. Our listener, a really keen real estate professional, they reached out with a unique request. They gave us the raw source material articles, market reports, their own notes stuff that was actually slated for an upcoming episode of their favorite weekly podcast, The Wire. Whew. So this deep dive, it's our analysis of their source material. We're extracting the most important themes, the surprising insights, and those critical takeaways that The Wire's audience, fellow real estate enthusiasts and pros would find most valuable.
Exactly. Think of us as your research and analysis team for this. We've spent time sifting through this really fascinating, maybe even a little overwhelming collection of recent articles, industry analyses. It all spans from late June to early July 2025. And our mission here, it goes way beyond just summarizing what's on the page. We really want to connect those dots that maybe seem separate, uncover the deeper meaning, the significance, and pinpoint precisely what truly matters for you, our listener, as you navigate this very dynamic real estate landscape right now.
So what's the big picture we're diving into today? Based on the title The Wire was apparently gearing up for, it looks like a potential blockbuster. Airbnb's quiet betrayal in the insurance shockwave. Wow, just that title alone, it hints at some pretty seismic shifts, doesn't it?
It really does.
It suggests a market that's not just fluctuating, but actively rewriting its own rules. And maybe with some hidden coughs popping up. We're going to unpack these major themes, identify the unexpected turns, and hopefully give you that crystal clear understanding of what's truly at play. Let's get started. Okay, let's kick things off with what feels like, a perpetual motion machine in real estate news these days. I'm talking about the tectonic shifts happening within brokerages and, the broader industry associations. The sources we looked at, they paint a very active, almost combative picture, especially around NAR, the National Association of Realtors, and the huge ripple effects from all these various high-profile lawsuits.
Yeah, it seems like the whole industry is caught in this whirlwind of legal challenges and strategic maneuvering.
Definitely.
And what's truly striking here isn't just that there are legal challenges, but the sheer volume and the breadth of them. It's not just isolated incidents, right? This feels like a systemic reevaluation of some really fundamental industry practices. The ongoing discussions around NAR's role, that's central. We saw headlines like, looking past NAR drama to the heart of Hannah's success. Now, that piece is fascinating because it suggests that even with all the very public legal drama and internal turmoil NAR is facing, smart firms are still finding ways to succeed, often by doubling down on core brokerage values or, innovative strategies that kind of transcend the immediate NAR headlines.
So adaptability is key there.
It highlights critical adaptability, exactly. But then simultaneously, you see the counter narrative.
Yeah.
Like that headline, Senate passes big, beautiful bill with key NAR priorities intact.
Right. The language aside.
Yeah. Setting aside the colorful language of the bill's title, this piece reveals a really potent, often kind of unseen aspect of NAR's influence. Despite all the public drama, NAR is still wielding significant legislative power in Washington. They're successfully pushing through priorities that will shape the operating environment for real estate pros for years. So for you as an agent, this means political advocacy, maybe behind the scenes, remains a critical pillar of industry stability, even amidst all this internal upheaval. It's like this dual narrative, internal strife, but external legislative muscle.
That's a really crucial point. It's not just internal battles. It's like a multi-front war. And it's definitely not just NAR. We're seeing a lot of aggressive movement among the major players. A real high-stakes dance for market position, for control. Take Compass, for example. There was that headline boldly stating they has not and will not adhere to clear cooperation. That's a direct challenge to existing MLS rules.
A very direct challenge.
And then at the same time, you see the MLS making its case for dismissing the Compass lawsuit, defending its turf. For our listeners, many of you are deep in daily transactions. This isn't just some abstract legal skirmish. It feels like a direct assault on the mechanism that's historically centralized listing data.
Absolutely. Clear cooperation, just for anyone less familiar, basically mandates brokers submit listings to the MLS pretty quickly, like within a business day of public marketing.
Right.
So if more big players follow Compass and just decide not to adhere, well, that could seriously fragment the market. It could make it harder for you as an agent to get a complete view of what's actually available.
Yeah, I could see that.
It could fundamentally shift power away from the traditional MLS systems, maybe towards private data pools.
Yeah.
It could force agents to potentially subscribe to multiple expensive platforms just to see everything.
It really questions how listings are shared, accessed, and, ultimately who controls the information flow in our industry. It's fundamental.
You've hit on a core truth there. And this whole battle over listing data and market control, it ties directly into how commissions are structured, how agents get paid. Which brings us to another critical legal front. We're seeing headlines like the new commissions case pulls in brokerages that settled. That's got a sting.
Ouch.
And the PLS Umansky case. Ready for a rematch with NAR in refiled lawsuit. These aren't just abstract legal concepts for the average agent out there. These are direct threats or maybe opportunities, depending on how you look at it, that could redefine your entire business model.
Right. So how does this actually play out for an agent day to day?
Well, the original commission lawsuits challenged that long-standing practice of sellers paying buyer agent commissions, right?
Mm-hmm.
And these new cases, they're reigniting that whole debate, even for firms that thought they had put it behind them with settlements. So for you, the real estate professional listening, this means a period of, frankly, significant uncertainty, potential restructuring of how commissions are earned, how you manage buyer-broker agreements, maybe even how leads are generated and paid for.
We could see totally new fee structures emerge from this.
That's exactly. Different client relationships where buyers pay their own agents directly.
Yeah.
A shifting competitive landscape. It demands you keep a really close eye on these legal developments to understand the practical implications for your own earning potential, your operational procedures. It's a fundamental questioning of how value is created and, importantly, captured in a transaction.
So it's a fight for eyeballs, for data, and ultimately for the very toolkit an agent uses to operate. Who owns the customer relationship? Who owns the data?
Right.
And who provides the best tools for agents to operate efficiently, profitably? And alongside these legal battles, we've seen some absolute massive acquisitions and strategic tech plays, seemingly driven by this desire for scale, efficiency, integrated services. Like Rocket finalizes USD 1.75 B acquisition of Redfin. That is a truly massive consolidation.
Yep.
Bringing together a mortgage giant with a tech-forward brokerage known for its direct-to-consumer model. And then we have Real acquires home search tech from Fly Homes, another tech play. What does all this intense consolidation mean for the industry's future? Is it purely about grabbing market share, or is there a deeper strategy here, like becoming a singular one-stop shop, dominating the whole real estate journey from search to close?
Well, if we connect this to the bigger picture, it really signifies a powerful, and I'd say accelerating push towards fully integrated end-to-end services. And it's driven by technology. The Rocket Redfin deal, for instance, it's not just about mashing two companies together. It's about creating a seamless experience for consumers, right? From their very first home search all the way through financing and closing.
Less friction.
Exactly. It's a play for more than just market share. It's about owning more of the customer journey, reducing those friction points, and extracting value at multiple stages along the way. Now, this kind of vertical integration, it could offer undeniable convenience for consumers, sure, but it also raises questions about competition and choice for you, the agent, and other service providers.
And Zillow's in the mix too, always.
Oh, predictably. Zillow is a major player in this evolving landscape. We saw reports like Zillow readies for battle with Compass, and significantly, Zillow is now enforcing its listings ban. Now, that directly impacts how agents access and use listing information. Zillow's strategic pivot towards more direct control over listings, potentially limiting third-party access for certain brokerages like Compass, that's a clear move to consolidate its power as the primary gateway for home searches.
They want to be the front door.
They want to be the default starting point for every single prospective buyer. Absolutely. It underscores this fundamental shift where these big digital platforms are increasingly dictating the terms of engagement in the marketplace. And that could potentially marginalize those who rely solely on, the more traditional methods.
So it's a massive power play. But, amidst all this consolidation and the legal wrangling, it's really interesting to see that dichotomy you mentioned earlier, the headline, "Indies flex their muscle as the big brokerages get bigger." It seems like both ends of the spectrum aren't just surviving, they're actually thriving, maybe by offering fundamentally different value propositions.
Seems to be the case.
Estate properties, for example, they made a very public choice for independence, right? Emphasizing our agents are our brand. That suggests that while the big companies are consolidating through M&A and tech buys, there's still a strong pull, maybe even growing towards agent-centric models, where personal branding, local expertise, direct client relationships are paramount.
This truly highlights the diverse strategies playing out in the market. It illustrates that there isn't just one single monolithic path to success in real estate today. While some brokerages are absolutely scaling through acquisition, technological integration, aiming for that operational efficiency and market dominance, others are doubling down on agent autonomy, on brand loyalty.
So the indies flexing their muscle.
Yeah, it suggests that a personalized, relationship-driven approach is still highly valued by clients and by agents themselves. Agents who prioritize building their own brand identity, leveraging their local market knowledge, their personal networks, they can absolutely find significant success outside that mega brokerage model.
So there are real choices for agents.
It provides a spectrum of options for you, the agent. It allows you to choose the environment that best fits your working style, your client base, your career goals. But it also creates a more fragmented yet dynamically competitive landscape, where all these different models have to continually prove their value proposition to agents and to consumers.
It's a powerful reminder, isn't it, that niche markets, personalized service, they can still thrive even as the giants get bigger and more integrated.
Absolutely. So the key takeaway from this whole section for any real estate pro listening is probably this. You have more choices than ever about where and how you affiliate, but really understanding the strategic direction of your chosen partner, whether it's a mega firm or an independent, that's paramount right now.
Okay, let's pivot now. Let's talk about where the rubber really meets the road for most buyers and sellers just trying to make sense of the current market. And here's where it gets really interesting, especially when we look at the macroeconomic forces at play. The sources we reviewed, they paint a pretty mixed, almost contradictory picture when it comes to interest rates, job growth, housing affordability.
Yeah, mixed is a good word for it.
It's almost like the market can't quite decide what it wants to be when it grows up, leading to a lot of confusion on the ground.
Well, what's fascinating here is the immediate and often kind of counterintuitive impact of these economic indicators on the housing market. Take that headline. Strong jobs report throws cold water on July rate cut, reported on July 3rd. Now, for many prospective homebuyers, strong job growth feels like good news for the economy overall, right?
Yeah, you'd think so.
But it's often perceived as bad news if you're hoping for lower mortgage rates. The underlying logic is that strong job growth often fuels consumer spending, which, in turn, can contribute to inflationary pressures. And the Federal Reserve's main tool to fight inflation, it's raising or maintaining higher interest rates to cool demand.
Right. So good job numbers mean the Fed thinks the economy can handle higher rates.
Exactly. It gives the Fed less incentive to cut rates, much to the disappointment of homebuyers. And this directly influences mortgage rates. We saw them fluctuating throughout the week in the daily updates from the mortgage reports, highlighting just how sensitive they are. Even small shifts in economic data can have a material impact on a buyer's purchasing power, their ability to qualify for a loan.
That explanation really clarifies why good news for the economy isn't always good news for mortgage rates. It's tricky. And speaking of affordability, wow, one report in our sources hit me particularly hard. It just underscores the immense challenge facing so many Americans right now. It was the Zillow data from June 30th. Buyers need a $17,000 raise to afford a home.
Yeah, that number jumps out.
$17,000. That's a staggering barrier, especially when you consider average wage growth hasn't really kept pace.
Not even close.
It puts into stark perspective just how out of reach homeownership has become for many. It creates this clear, widening disconnect between typical household incomes and soaring housing costs across the country.
Indeed. And it raises a critical question about the sustainability of current home prices versus wage growth. When the income required to afford a home jumps by such a substantial margin, I mean, $17,000 is not a small sum for most households. It signals this widening affordability gap that just can't be easily closed without, significant market corrections or substantial sustained increases in buyer income.
It's a systemic challenge.
Definitely. And while we saw reports of seller optimism high, despite increased risk of taking a loss, which might seem contradictory.
Yeah, how does that work?
Well, the mortgage reports offers a crucial counter perspective. They stated pretty clearly, it's no longer a seller's market. So this contradiction suggests a really fascinating market dynamic. Sellers might still be clinging to the notion of peak market conditions, high demand, maybe influenced by the recent past. But the reality on the ground, reflected in buyer behavior, negotiation power, the overall market data, it indicates a clear shift in leverage towards buyers.
Buyers are pushing back more.
They're becoming more discerning, more patient, less willing to overpay, even if affordability is still a personal challenge for them. It's a market in flux where perception and reality are still kind of converging, and where knowing the actual market dynamics is critical for both sides of any transaction.
It certainly feels like buyer sentiment is shifting. They're becoming much more discerning. That's a big change from the frenzied bidding wars of just a couple of years ago.
Huge change.
So what about supply? That's always the other side of the coin. We saw some conflicting signals here too, which makes it hard to get a clear picture. There was a positive note. 2 or more story home starts rebound in 2024. And solid job growth in June for construction. That sounds promising, right? For increasing inventory, maybe easing supply pressure.
On the surface, yes.
But then we also have reports of flat job openings for construction and private residential construction spending dips. So are we actually building enough to meet demand? Or are these mixed signals hinting at continued supply-side challenges, keeping prices stubbornly high?
Well, if we try to connect these dots, look at the bigger picture.
Yeah.
Despite some positive signals in those multi-story starts, the overall construction landscape suggests a continued systemic challenge in truly meeting the housing shortage that plagues so many regions. Starting more multi-story homes is good for density, sure, but the flat job openings for construction, the dipping private residential spending, that indicates the industry might still be constrained.
By what? Labor? Costs?
Could be fundamental issues like labor availability. Absolutely. Rising material costs are still a factor. And perhaps a reluctance from developers to overbuild in such an uncertain interest rate environment. It means that despite growing demand, the pace of new supply might still be too slow to make a significant dent in the housing deficit.
There was that quote.
Yeah, the RXR CEO put it very concisely. The way to deal with housing shortage is to add more supply. The challenge isn't just starting homes, it's completing them efficiently, sustainably, at scale.
But there are efforts to address it.
On a more optimistic note, yes. You saw California passing that sweeping reform to expedite new housing. That indicates a growing acknowledgement from policymakers that active intervention is needed to overcome regulatory barriers, to accelerate construction. That's a hopeful sign for the long-term supply picture, at least.
That gives a clearer view of the supply puzzle. So, with high prices and tight supply still very much a reality for many people, how are they coping? It seems like buyers are getting incredibly creative, adapting their strategies just to navigate this challenging market. Multi-generational home buying, for instance, hit a record high. That's a clear adaptation to the affordability crunch, right? Families pooling resources, sharing the financial burden.
A very clear adaptation.
And there's increasing talk about taking assumable loans seriously in this gridlocked market. That seems like a really savvy move for buyers looking to snag a lower interest rate tied to an older existing mortgage.
It can be, yeah.
For our listeners, maybe just a quick reminder. An assumable loan basically means the buyer takes over the seller's existing mortgage, often at a much lower historical interest rate. In a market where rates have jumped from, say, 3% to 7% in just a few years, securing an assumable loan at 3.5%, that could save a buyer hundreds, even thousands per month.
Huge potential savings.
These aren't just anecdotes, right? They show this profound resilience, this ingenuity in the face of tough market conditions.
They absolutely are adaptive strategies born out of necessity. They demonstrate how market forces push consumers to innovate beyond the traditional buying methods. Multi-generational home buying, it isn't solely about affordability either. It also speaks to cultural shifts, maybe a desire for communal living. Often driven by economic necessity, yes, but also offering benefits like shared childcare, elder care.
Sure.
And the surge in interest in assumable loans, that highlights a particularly astute approach to try and circumvent the current high interest rate environment. It offers a potential lifeline for buyers by fundamentally changing their affordability calculation, making homes viable that might otherwise be out of reach.
But they're not always easy to get, right?
That's the caveat. It's worth noting that while they can be powerful, assumable loans often come with complexities. Like you usually have to cover the equity gap, the difference between the sale price and the remaining mortgage balance in cash. That can still be a significant barrier for many buyers.
Ah, okay.
We also saw mortgage refinance demand surging when rates dipped earlier in the week. That just indicates how keenly sensitive homeowners are to rate movements. When rates dip even slightly, there's this immediate rush to try and lock in lower payments. It underscores the pervasive financial pressure many homeowners and potential buyers feel, and how quickly they react to even small, favorable shifts in the market.
Okay, now let's get to the surprise elements, the things teased in the Wire's potential episode title. This deep dive wouldn't be complete without really digging into Airbnb's quiet betrayal and the insurance shockwave. These feel like two areas where the ground is genuinely shifting beneath investors' feet, and maybe not always in their favor, creating unexpected new risks that demand immediate attention.
What's truly fascinating here is the direct and often immediate impact these changes have on short-term rental investors, STR investors, and property owners generally. It fundamentally alters their business model, their risk exposure. That BRRRR article titled "Airbnb Just Quietly Changed the Rules for Hosts" is particularly noteworthy.
The key word being quietly.
Exactly, quietly. It implies a lack of fanfare, which can catch hosts completely off guard, right? Potentially leading to unforeseen liabilities or operational headaches. This article is a critical read for anyone in the STR space because it highlights how platform changes can directly impact your bottom line, often without much warning.
So what exactly were these quiet changes? What does this really mean for hosts, for property owners, especially those relying on STR income? What were the specific updates and what are the practical implications?
Well, the article details specific updates to Airbnb's terms of service that could significantly alter host responsibilities and liabilities, particularly around guest behavior and property damage. Historically, many hosts might have felt a strong sense of protection from Airbnb's host guarantee programs, right? Often perceiving them as this comprehensive safety net.
Yeah, like insurance almost.
Kind of. But these quiet changes, they seem to shift more onus, more responsibility directly onto the individual host. For instance, there could be new, more stringent requirements about how hosts manage disruptive guests, maybe mandating immediate intervention or a stricter adherence to local noise rules, or there might be more rigorous demands on the condition and safety of their properties going beyond what was previously expected.
So it's more than just a minor tweak.
Oh, yeah. It necessitates a profound reevaluation of host agreements, their individual risk tolerance, and maybe most crucially, their liability coverage. That question from the other BRRRR article, you might have property insurance, but is the rest of your short-term rental protected? That becomes incredibly pertinent now.
Right. Is your standard policy enough?
Probably not. Hosts need to meticulously review their existing policies. Homeowners, landlords, specialized STR insurance to make sure they adequately cover these potentially expanded responsibilities. A standard homeowner's policy almost certainly won't cut it for commercial STR operations. It leaves them exposed to significant financial risk from unforeseen guest actions or property issues.
That's a huge potential blind spot for a lot of hosts, I imagine. And it connects directly to the broader discussion about the evolving role of STRs in the housing market, right?
Yeah.
And the risks versus benefits of owning specific property types, like beachfront property, often considered prime STR investments.
Exactly.
If the terms of engagement are changing this dramatically, the fundamental risk-reward calculation changes too. A property might have incredible earning potential, sure, but if the liability burden increases significantly, that potential gain could be quickly eroded by unexpected costs, legal issues, damage claims.
Completely changes the math.
We even saw articles discussing the top 10 NFL markets for Airbnbs, suggesting strong demand in certain areas due to big events, tourism. But these new rules could add a significant layer of complexity for hosts in those lucrative markets. It might force them to adjust pricing, increase deposits, or even reconsider investing in STRs if the balance shifts too far towards host liability.
Precisely. The shift in Airbnb's terms directly impacts the profitability, the overall viability of short-term rental investments. It could potentially dampen the enthusiasm for new STR acquisitions, especially in markets already facing regulatory scrutiny over STRs. And this leads us seamlessly to the other major shockwave impacting property owners across the board, the rising cost of homeowners insurance. CNBC reported on July 2nd that homeowners insurance premium rates in every U.S. state are going up.
Every single state?
Every single state.
Right.
This is not an isolated incident, not a localized thing, not a minor adjustment. This is nationwide, a fundamental shift. It signals a pervasive reassessment of risk by insurance providers across the entire country.
Wow. Okay. Every U.S. state. That's truly monumental. It implies this isn't just about, hurricanes in Florida or wildfires in California.
No, it's broader.
So why is this happening? What are the underlying drivers, the compounding factors making insurance costs surge everywhere?
Well, it raises an extremely important question about the multifaceted factors at play. And unfortunately, they are compounding. The sources clearly hint at increased climate threat impacts on U.S. infrastructure. And critically, more frequent and more severe weather events leading to substantially higher claims.
So more storms, more fires, more floods.
Exactly. More intense hurricanes in the southeast, escalating wildfires out west, widespread floods in unexpected places, even more severe convective storms like tornadoes, hail causing unprecedented damage across diverse regions. This directly translates to higher payouts for insurers, who then naturally pass those increased costs onto policyholders like you.
Makes sense, unfortunately.
But it's not just climate change. It's also inextricably tied to overall inflation in construction costs for repairs. When a roof needs replacing after a hailstorm, or a whole home needs rebuilding after a flood, the cost of materials, lumber, concrete, roofing supplies, coupled with a persistent shortage of skilled labor. Those costs have escalated significantly.
So claims are getting bigger, too.
Much bigger claim values, putting further pressure on insurers. It's this double whammy, increased frequency and severity of events, plus higher repair costs. Insurers are facing massive liabilities and adjusting premiums accordingly. And this impacts profitability for landlords, too. Even seemingly smart business decisions, like that article saying yes to pets pays off for landlords, where you might charge a premium for pet-friendly units.
Yeah.
That becomes more complex calculation now. What might have looked profitable suddenly looks less attractive if baseline operational costs, like insurance, are soaring and eating into those gains.
So for both Airbnb hosts and traditional landlords, these rising insurance costs, they aren't just a minor line item anymore. They've become a critical, maybe often surprising part of operating expenses.
Absolutely critical.
It's a major variable that needs careful, proactive management. It might require landlords to reevaluate rental rates, reassess the financial viability of certain properties, maybe even consider divesting in high-risk areas. This is a significant headwind that maybe wasn't as prominent just a few years ago. It's fundamentally reshaping the financial landscape for property owners.
It absolutely reshapes the financial models. It demands a much deeper look into insurance policies, potential vulnerabilities. It means more than just shopping around for the lowest premium. It means really understanding what risks are covered, what exclusions exist, whether your current coverage adequately protects you against these increasing threats. Proactive risk management, maybe property upgrades for resilience, like reinforcing roofs, elevating utilities in flood zones. That becomes more financially compelling now as a way to mitigate these rising costs long term.
Shifting from reactive to proactive.
Exactly. From reactive crisis management to proactive risk mitigation. That's the key.
Okay, so beyond all the challenges we've outlined, the legal battles, the economic headwinds, these emerging risks, were there any bright spots, any areas of innovation that came out of the sources? It can't all be doom and gloom in the real estate world, right?
Yeah.
How is the industry showing its adaptability?
Yes, absolutely. Despite the significant headwinds, there are clear and I think exciting signs of innovation and adaptive strategies emerging across the real estate spectrum. We saw promising discussions around the role of prefabricated homes in affordable housing, thinking of that as a viable, scalable solution to the persistent supply shortage.
Prefab, yeah.
Prefab homes offer immense potential for faster construction times, significant cost efficiencies because of the factory-controlled environments, consistent quality. It directly addresses some core issues in housing supply and affordability. And these aren't, your grandfather's mobile homes. These are often architecturally designed, energy-efficient units that can be built and deployed much more rapidly than traditional stick-built homes.
And mixed-use developments.
We also saw a discussion on the benefits of blending residential commercial properties in mixed-use developments. This represents a really powerful adaptive approach to urban design, to density. By moving away from rigid single-use zoning Cities can create more vibrant, walkable communities that combine living, working retail spaces. It not only helps alleviate housing pressure by increasing density, but it also enhances quality of life, creates more sustainable, dynamic urban environments. These are tangible ways the industry is actively trying to build smarter, more efficiently, more inclusively.
And the push for digitally connected infrastructure seems to be growing exponentially, extending beyond just our homes, right? We saw reports of an increasing appetite for digitally connected sheds, which I admit sounds almost quaint at first.
A little bit, yeah.
Until you realize that WiredScore, a major player in building connectivity ratings, is now expanding into the industrial logistics sector. That's a fascinating development. It suggests that even seemingly simple structures like industrial sheds are becoming more sophisticated integrated hubs within a broader tech ecosystem.
That's a perfect observation.
It highlights the growing importance of seamless connectivity, smart solutions across all real estate segments, not just residential.
It really reflects a broader, accelerating trend towards efficiency and sophisticated technology integration in real estate. Spanning from residential units to massive industrial complexes, it's fundamentally about leveraging innovation to address these multifaceted challenges, whether it's affordability, supply chain optimization, or just operational efficiency. The demand for digitally connected industrial spaces, for instance, it speaks directly to the growing need for smart warehouses, logistics hubs that can optimize supply chain operations through automation, real-time tracking, predictive analytics.
So real bottom line impacts.
Absolutely. These innovations aren't just incremental improvements. They represent strategic shifts in how properties are developed, managed, utilized to meet evolving market demands and overcome these persistent obstacles. It's really a testament to the industry's deep capacity for problem solving, its continuous drive to find new efficiencies, even in the face of significant challenges. For you, our real estate professional listener, understanding these technological shifts isn't just interesting background noise. It's critical for identifying future investment opportunities and ensuring your properties remain competitive and valuable in the long run. Hashtag key takeaways and provocative thought.
Okay, this deep dive into what The Wire might have covered using their source material has been incredibly insightful, revealed layers of complexity, but also opportunity in today's real estate market. Let's try to synthesize it all now. Summarize the 3 core themes we identified, pinpoint those surprising insights that might have flown under the radar, and offer one big takeaway specifically for you, our listener, the real estate pro immersed in this world.
Sounds good. Our first key theme, really the bedrock of our discussion, was the dynamic and often turbulent landscape of brokerage and industry power dynamics. We saw the ongoing NAR discussions continuing to reshape the association's role and influence. We saw the various high-stakes lawsuits Compass, PLS Humansky, directly challenging established commission structures, data sharing practices, fundamentally questioning the decades-old business model.
A lot of uncertainty there.
Huge uncertainty. Simultaneously, there's that powerful drive towards consolidation, rocket buying Redfin, indicating a push towards integrated one-stop shop services. Yet, paradoxically, you have the simultaneous rise of independent brokerages, like estate properties, flexing their muscle by focusing on agent-centric models. This whole intricate web legal battles, corporate maneuvers, grassroots movements, it indicates a period of profound restructuring in how real estate business is done, how agents operate. It demands constant vigilance from every professional.
Okay, theme 1, restructuring and power shifts. What was number 2? Our second core theme focused on the macroeconomic currents influencing housing affordability and broader market conditions. We saw how strong job reports, paradoxically, might not lead to immediate rate cuts, prolonging higher borrowing costs as the Fed battles inflation. We talked about that stark reality, the $17,000 raise needed to afford a home stat, underscoring the immense growing affordability gap.
A sobering statistic.
Definitely. We also noted the subtle but significant shift away from a pure seller's market. Sellers might still be optimistic, but market signals suggest increasing buyer leverage. It's a market grappling with persistent supply shortages despite some positive construction signs and that widening affordability gap. But this has spurred incredible adaptive strategies from consumers, record multi-generational home buying, rising interest in assumable loans, creative solutions to navigate a challenging landscape.
And our third theme explored those emerging risks, niche market trends. This is where we uncover the most surprising, maybe immediately impactful insights for property owners and investors. First was Airbnb's quiet rule changes. These could significantly impact host liabilities and operations. Those subtle updates to the terms of service seem to place more responsibility on hosts for guest behavior, property damage. It requires a diligent, immediate review of protection strategies, insurance coverage, maybe even host agreements. It's about potentially increased financial exposure.
Not just an inconvenience.
Not at all. The second was the homeowners insurance shockwave. Premiums rising in every single U.S. state. This widespread increase is driven by that compounding combination. Increased climate threats, causing more frequent severe weather alongside rising construction costs for repairs. These are not minor adjustments to your balance sheet. They represent critical, escalating operating expenses that demand immediate attention from property owners and investors. It fundamentally reshapes the financial viability and profitability of their assets.
Okay, so after sifting through all of the wire source material, analyzing these three core themes, those crucial, surprising insights, what's the single biggest, most impactful takeaway for you, our real estate professional listener, from all of this?
The overarching takeaway, the thread that runs through every aspect of this deep dive, is the critical importance of vigilance and, I'd say, aggressive adaptability in this rapidly evolving real estate market.
Yeah.
From the shifting brokerage landscapes and legal battles redefining how business is done, to the macroeconomic forces dictating affordability and buyer behavior, and right down to specific, sometimes hidden niche risks like Airbnb rules and soaring insurance costs. Staying intimately informed, proactively adjusting your strategies, embracing innovative solutions that is paramount, not just for survival, but for success.
So no resting on your laurels.
Absolutely not. The market is dynamic, complex, sometimes unforgiving. Relying on outdated assumptions or failing to anticipate emerging challenges could put you at a significant disadvantage, erode your profitability. Success now really hinges on your ability to pivot, innovate, and continuously learn.
That's a powerful and really actionable takeaway for anyone in this industry. So here's a final provocative thought for you to chew on as you go about your week. In a real estate market defined by constant shifts, unprecedented economic pressures, and often unforeseen challenges, is the greatest asset an agent or investor can possess not just deep market knowledge, but perhaps more importantly, the agile mindset to pivot and innovate, especially when the rules quietly change right beneath their feet. And that wraps up another deep dive. We truly hope this journey through the wire's potential source material has provided you with some clarity, some context, and maybe those valuable aha moments that will empower your real estate business.
Our goal is always to equip you with the insights to be the most informed, most adaptable, and ultimately the best version of yourself in this dynamic world of real estate. Thank you so much for joining us on this deep dive.
If you want to continue your own deep dive into these fascinating topics, remember to stay curious, keep asking those questions, and just keep learning. We'll be back next time with another stack of sources to unpack right here on The Deep Dive.
If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, the week in real estate. Thank you for listening.